What if I told you that some of the most powerful rules for building wealth, well, they go against pretty much everything you've ever been taught about money? We're always told to play it safe, get out of debt, and definitely fear market crashes. But what if the wealthiest investors are playing a completely different game? It's time to flip the coin and see what's on the other side.
It all kicks off with this one simple yet pretty staggering number. When it comes to money, you can forget that 80-20 rule you've probably heard about. The reality? It's way, way more skewed. We're talking about the 90-10 rule.
So here's how it breaks down. Just 10% of the population controls a whopping 90% of all the money. And this isn't just about finance. You see the same thing with top actors, athletes, musicians, you name it. So you gotta ask yourself, what on earth does this 10% know that the other 90% doesn't? And the answer really comes down to this one powerful idea. Wealthy investors have learned to see both sides of every single financial coin. While most of us are trained to see only risk, or only debt, or only fear, this group has trained themselves to see the opportunity that's always, always on the other side.
And that's exactly what we're about to do. We're going to flip that coin over and break down 4 rules that just completely contradict conventional wisdom, and they might just explain this massive wealth gap.
Okay, let's dive into the first one, and it's a biggie, risk. The mantra for most of us is play it safe, but the wealthy, they have a completely different playbook.
The real shift in thinking is this: the average investor avoids risk at all costs. The rich investor, on the other hand, doesn't just seek risk for the thrill of it. No, they focus on improving their financial skills so they can take on bigger, calculated risks, because they know that's where the bigger rewards are hiding.
So how do they do it? Well, it's a process. It all starts with financial education, actually understanding the game. Then comes the real-life experience, getting out there, making some mistakes, and learning from them. That combination builds the skill and the confidence to manage opportunities that most people would just see as way too risky. Suddenly, risk becomes an advantage, not something to run away from.
All right, let's move on to our second contradiction, and this is one that makes a lot of people pretty uncomfortable. Debt. We're told to cut up our credit cards, pay everything off, avoid it like the plague. But what if some debt could actually make you richer?
And here's that other side of the coin again. While the average person is focused on getting rid of all their debt, the rich investor is out there actively looking for ways to increase a very specific kind of debt, what we call good debt. So what in the world is that?
Simply put, good debt is debt that other people pay off for you. So for example, you get a loan to buy a rental property. Your tenant's rent covers your mortgage payment and all the expenses, and hopefully puts a little extra cash in your pocket. You're literally using the bank's money to buy an asset that pays for itself. That is a world away from bad debt, like using a credit card to pay for a vacation.
Okay, this next one is probably the most counterintuitive of all of them. For most people, the words market crash trigger absolute panic. But for the investor who's prepared, it's a completely different story. This is a complete 180 in terms of emotion and strategy. The average investor is terrified of a crash. They often panic and sell right at the bottom. But the rich investor, the one who's armed with cash and knowledge, sees a crash as the single greatest opportunity for creating wealth.
Think about it this way. A market crash is basically a sale, a huge one. Everything, stocks, real estate, entire companies are on a massive discount. So those who have the financial skills and are ready for that downturn can scoop up high-quality assets for pennies on the dollar. See, crashes don't really destroy wealth. They just transfer it from the unprepared to the prepared.
And that brings us to our fourth and final contradiction. This one goes right to the heart of how we think about our jobs and our income. The traditional advice is to get a good, secure job. But the wealthy? They're focused on something else entirely. A job provides what's called earned income. And guess what? It's the highest taxed kind of income there is. A business, on the other hand, is an asset. It's a system that's designed to make you money, and it offers way more control and upside than a simple paycheck ever could. And here is one of the biggest, most powerful advantages. As an employee, you earn money, you get taxed on it, and then you get to spend whatever is left. But as a business owner, your company earns money, it spends money on legitimate expenses to grow, things like equipment or travel, and then it pays taxes on what's left over. It's a fundamental change in the order of operations that makes a massive, massive difference. This quote just sums it up perfectly. Minding your own business doesn't mean being nosy. It means your number one focus should always be on building your asset column, whether you have a day job or not. You see, your job pays the bills, but it's your business that builds your wealth.
So, let's bring all this together. These 4 rules aren't about some secret hidden information. They are about a fundamental shift in perspective. It's all about learning to see the other side of the coin.
First, you shift from just fearing risk and always playing it safe to learning how to actually manage risk through education and real experience. Then, you change your view on debt from this big negative thing to be avoided to seeing good debt as a powerful tool you can use to acquire assets.
Next, you transform that panic you feel about a market crash into the anticipation of what it really is, the greatest wealth-building opportunity you might ever see.
And finally, you start looking beyond the idea of job security and focus instead on building a business, a true asset that works for you. Ultimately, the difference between the 90% and the 10% isn't about luck or some secret formula. It's about developing the financial education to see the entire picture, to see both sides of every single financial decision you make.
So I'll just leave you with this one question to think about. We know every coin has 2 sides. The real question is, which side have you been trained and conditioned and taught to see your whole life? And what do you think would happen if you started looking at the other one?